Like, I'm picturing in 2017, they have this proxy battle that's happening right now. They're trying to figure out how to not sell the company. And you look out your window and there's a dude with a flock of sheep. You're like, really? Why do I have to deal with this right now?
Again, it's like, that's what running a business is.
This podcast contains the arguably witty banter of two friends, Skippy and Douglas, that like to debate about investing. The content is intended to be entertaining and for informational purposes only, not investment advice. You should do your own research and consult a financial professional before using any of the information in this podcast, and especially before investing.
Skippy and Douglas back in the house with Deckers Part 2. If you have not listened to Part 1, you can go and do that. We'll do a quick recap here, but you can go and listen to that episode. Came out last week to get some more in-depth knowledge. What we hit on in Part 1 was the first 30 years of the company. Started in 1973. We took that through the early 2000s. And the very quick summary is UC Santa Barbara grads start this company. For a decade, ran it as a lifestyle business. Some river guide, geophysicist turned river guide, then took a flip-flop, put a strap on the back of it, and called it Teva. Then Deckers partnered with Teva for a long period of time, led to some explosive growth. They went public in 1993. The 1990s for the stock were not good, is the summary there. Then, starting in the early 2000s, we're going to hit on right now, things start to turn around. So the first 30 years, we're building the foundation of the company. Today in Part 2 is the core of why we're doing this, because we're going to talk about the period in which Deckers exploded from a stock perspective. This is all the returns end up happening in the last little over 20 years, and we're going to discuss how they did that. Before we kick this off, here's one thing I want to tell you. So we got a little bit of listener mail.
A bunch.
Yes.
I have a bunch too, yeah.
But there's one that I want to hit on because it'll speak to your spirit, to your soul. And I quote, "Super engaging episode." This is about Part 1. Super engaging episode. My only complaint is how Douglas says Teva.
Yep. That's the listener mail I got too. It's Teva.
It's
everyone,
not
Everyone is coming to my defense.
I know. Here's the whole thing. Because I was like, hold on, is it me? Because I'm pretty sure I got this right. It is Teva. just so everybody knows, it is Teva.
It's not. I mean, it doesn't matter. Like,
no,
if
I know. I get it. This is a Hebrew word. It is Teva. However, everyone pronounces it Teva. So we're just going to do that potato again. It don't matter. Okay? All right.
I continue to say that this is one of the more fascinating companies around. The 30-year history we talked about, to me, is just fascinating. But
yep.
More than that, this is where the action starts. So I have the chart up on my screen, and I'm going to talk more financial metrics than I did last time. Because
obviously
the financial metrics before were kind of boring. This is why we're talking about the stock. We're talking 2004 on. And this is from late August 2025 is my chart. I know your number's a little different, Douglas.
Yep.
But in that time period, the stock went up basically 10,000% from about $1.15 per share to currently $119.63. What they do in this, just from the financial perspective that I love, that I preach with my companies, that I preach with my investments, is you have very low debt. You buy back stock when it's advantageous, and in their case, they made great acquisitions, which is another thing. But looking at it now, Douglas, and giving this perspective, you just go, oh, they must have been on Easy Street the whole time. If we really go year by year through the timeline, you're going to see restructuring here, restructuring there, optimizing costs there. Like, they worked to go the stock 10,000%.
And this is what I love about going back and looking at company performance historically. Like, so not saying what are people saying today it happened, but going year by year, looking at annual report, articles, et cetera, because you get to see the real full story. The easy street answer to how did Deckers become Deckers? You go, 30 years, first 30 years, everybody hits bumps, you in that startup mode trying to figure it out. But then they went on Oprah, and the rest is history. That is the easy answer. That's a core part of the story. But to your point, we're going to walk through, there's so much that happened in those last 20 years. As a reminder to everyone, if you did not listen to the first episode, I'm going to hit on this, but as a reminder for those that did, during that first decade of them being public, from 1993 to, let's just call it 2003, the stock went down by over 90% and then came back up to even. So from the period that you were just talking about in 2005-ish, all of the returns that you see from the IPO happened in these last about 20 years. Although really they had to bounce back from 90% down. So it's huge. If you go from that period of time, it's huge, 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 huge.
Mm-hmm.
All right. You ready to start?
Yeah, let's go.
Okay. I'm going to go back a little bit further to recap some of what we hit on at the end of last week's episode, and then we'll jump all into the new stuff. Let's go to 1999. This is the point where Teva, potato, where Teva is saying at this point it's not owned by Deckers. It is licensed by Deckers, and Mark Thatcher, who was the founder of Teva, is like, I'm going to take my business elsewhere. But then they close an agreement to say, okay, we're going to license to 2011. So that gives a little bit of breathing room. Deckers was already on its back foot. It was scared, and that happened. Also, in this period of time, behind the scenes, because Deckers had purchased UGG for about $15 million back in 1995, they started to do a little bit of that seeding, celebrity seeding, building a relationship with Oprah. They started doing that in 1999, and what that culminated in was a bunch of celebrities wearing these sheepskin boots around, and in the Christmas episode of the year 2000, Oprah puts Uggs on her favorite things list. This gets a little catalysm going. Hey, do you know what a catalysm is?
You're making up words.
That's exactly what a catalysm is. Some people call it a catalyst. Tiva, catalyst, all the same. All right. I'm going to take a little detour right now because I found this to be interesting. Over the years, there are different pieces of the history of UGG that came up. And so I want to put together from a few different historical pieces, articles, etc., what it seems like the history of UGG is, because it starts to become more and more important over the years. We're going to come back to it, but I'm going to give it now because this is when UGG becomes a big part of the Decker story.
I mean, I don't even know where you're going with this, so let's spit it out already.
Okay. So there was this guy, a self-proclaimed high-qualified shoemaker by the name of Frank van de Mortel. He moved to Australia from the Netherlands in 1956. So he sets up shop in Sydney, starts making crocodile skin boots, blue suede shoes. This dude was a shoemaker of shoemakers. Then he begins making sheepskin slippers. His wife says, "Dem slippers is ugly." And he said, you know what? That's what I'm going to call them. So he put up signs advertising UGG boots, UGG boots. So this is late 1950s, early 1960s. As he said, my spelling wasn't that good. And so we must have thought that ugly was spelt with two G's. So that's like when the term first started. So then in Australia, the term UGG boots, lowercase UGG, was just a short term for ugly. Again, this becomes very important and not too long. Just a short term for ugly. Now, how does it come to the U.S.? So in the U.S., there was someone in Western Australia, this place called Albany. In Western Australia, there was a footwear manufacturer. His name was George Bircher. He had this shop with his wife. They owned this shop called Wombat Lodge in Albany. And he saw that these UGG boots were selling like crazy in his own terminology in their local surf shop. So he goes, you know what? I'm going to start exporting these things to the U.S. This is late 1970s, 1978, 1979. This Australian who lived in California, and this is what we touched on a little bit in the last episode, an Australian who lived in California, his name's Brian Smith. He saw one of Bircher's advertisements in the U.S.-based Surfer magazine. And he's like, Dems is hot. And he knew surfers, when they get out of the water, you talked about this, when they get out of the water, their feet is cold. So they got to put on these comfy UGG boots. He's like, these things are going to sell pretty well. So he then starts to sell. He starts working with Bircher and as an exclusive business partner, I believe at the time, selling these UGG boots in the U.S. Then in 1995, I'm going to skip ahead about 15, 16 years. 1995, he sells the business to Deckers Corporation. And now let's fast forward another 5 years to the early 2000s. I just thought it was an interesting little history there. Okay. Oprah puts it on the show. You got celebrities wearing around all the time. 2002, Deckers finally buys Teva. So Teva was Deckers at this point in time. If you recall, the vast majority of sales was coming from Teva. They finally bought it. This starts to change two things. One, the financial potential of the organization, the financial footing and stability exists because now you own Teva. So all the licensing and margins that went out the door, you have stronger footing. Plus, with the Oprah and celebrities, you now have your potential next growth engine. And this is the point where we mentioned the stock now gets about back to even, but Deckers is pretty much in trouble. I will tell you this. 2001 was just a crap year for Deckers. So as all this stuff is happening, still a crap year. For the first 9 months of the year, sales dropped by 20% for Teva compared to 2000. Simple sales, which is another one of their brands, fell by 30%. It was just garbage. The stock was selling, the market cap was about $40 million in valuation, and they had $90 million in sales. We're going to contrast that to once we get to 2024, what that looks like. $40 million market cap, $90 million in sales. Doug Otto, who's one of the UC Santa Barbara grads, owns about 35% of the company at this point. That's important because he has veto power over any takeovers, and takeovers were high potential right now because the stock was so potentially cheap. At least it was low valuation. Any comments so far, or you want me to keep going?
No, but when we find the next Deckers trading at that valuation, the Skippy and Dougal show are just taking it over. Just wait. I can't.
Yeah, that's exactly right.
Sharing it with our listeners. We'll have some cool shoes.
Yes, there you go. Okay, so we're at this point, crap year, valuation low. There's one potential takeover offer that came in. Doug Otto has veto power, and because of that offer, fiduciary responsibility, Decker starts working with RBC Capital to look at what other potential suitors there might be. This does not end up coming to fruition, but why this is important, if you think about the explosive stock growth that you talked about before, all of this could have been gone for $100 million.
Yeah. Well, but it would have been gone to a group that was likely more money hungry with a shorter term focus.
That's right.
That might have turned the thing around. It would not be this success. There's two key components there. There's that, which is it would go to people that actually don't love what they do, and they would drive the thing into the toilet in most cases.
Yep.
The other piece is we just talked about the 10,000% growth. Like, the reason that's so explosive is because it started from such a low base with low expectations in a time of challenge.
That's right. Absolutely right. Denominators
so anyone,
matter, people.
There's no one out there. Literally, please write us an email, skippyanddouglas@gmail.com. There's no one out there that has held the stock since 2004 and holds it today. Zero people. Maybe Doug
Otto.
Zero other people. But if you did, and you're trying to brag to your friends at the cocktail party that you saw this brilliant company and you were all in and you knew it was going to be one of the best performing stocks over that period, you're just lying. That was not the real case in 2004. That was not reasonable to believe.
Yeah, it makes me think about the person that got that perfect March Madness bracket like 15 years ago, and they were breaking down game by game. They're like, I knew Bucknell was going to take down Kansas because I was like, no, you didn't. Like, you guessed. You like the color of the uniform. Whatever it is. That's exactly right.
Wait, that's actually true? There's one perfect bracket out there?
There may have been more, but I remember when that one happened. There might be more since then, but I remember when that one happened.
I think you're lying. Get the lies off this podcast. There's no perfect bracket.
Yeah. In summary of this time, there's a lot of crap that was going down, and you'll see this, I think, one or two more times with Deckers. We've already seen it before, where they double down and end up betting again and take risks and take restructures, and it has ended up paying off for them. During this time, we discussed how in 1995 they had that restructuring where they basically consolidated they took it from brand focus to consolidation. In 1999, they started another restructure that's starting to come into fruition here, where they went back to each of the brands running themselves. And so all of this stuff that they're trying to put into play, the purchase of Teva, they've got the restructuring, is potentially at risk because of these purchases, because their stock price is so low. Things are no bueno. Okay, so now, 2003. We're basically back to where we ended the last one, except a little more detail this time. 2003 is when UGG really starts to take off. So that flywheel that they got going with the celebrities, with Oprah, really starts to take off. For the first 9 months of 2003, Deckers generated almost $7 million in earnings. 1 year prior, that was $257,000. Those are different numbers.
I mean, so UGG is named Footwear Brand of the Year by Footwear News, my favorite publication. Let's see. I have UGG sales for 2003 estimated at $32 million, which is up from $23 million in 2002. Like, explosive growth, right? And this, in 2003, I feel like UGG hits its stride in terms of knowing what it is and being the standalone mini powerhouse. Would you agree?
Yep, that's right. That's exactly right. And to get back, mentioning the stock price, it gets back to about even to where it IPO'd. So the stock went up 5x or so in 2003 to get back there. In 1 year, regained all the nonsense that it had lost from the IPO. Curse / in the end, not curse, benefit of what happened here is the retailers, neither Deckers nor retailers, anticipated how UGG sales would actually start to take off. So there was really low inventory. You couldn't find the Uggs that you wanted. What this led to was a lot of chatter, a lot of going on eBay, which was starting to become even bigger at this point in time. People had to find Uggs wherever they could find them. Again, curse, some might say, but it's actually really lucky. And Deckers talks about this a little more because they say that from the get, they've always tried to have control over distribution. They never wanted to be a place that was, or a brand, a company that had ubiquitous product everywhere. And so to them, the benefit that could come from this, the word of mouth, they're talking about it, is a little bit planned because they didn't want to overextend themselves. This is also the point, going back to that origin story for UGG, where the generic term of UGG in Australia and the trademark of it in the US begins to hit a head. And this will continue for like the rest of existence. But this is where, because now there's success, that folks in Australia are starting to get a little bit upset that they can't sell, and Deckers starts with their lawsuits. You have to protect your trademark. It's sucky, but you got to protect the trademark.
Yes.
I don't think we'll hit on this later because it's such a small story, but something that one of the things that I won't say I enjoyed, because these are, humans and their businesses, but I thought was entertaining, was if you fast forward a whole bunch of years, there was one lawsuit between someone named Eddie Uyghur, I think is how you pronounce his name. And out of protest, he drove to Deckers. He flew from Australia and drove to Deckers HQ with a flock of sheep and sat in the front yard. And there was a picture in I think it was the Australian Broadcast Corporation News. There's a picture of this man and a bunch of sheep with a big sign standing outside of Deckers. And I can only imagine the way the Deckers, we'll get to what was happening in 2017, but the Deckers folks must have been like, this is literally, I can't deal with this right now. There are sheep out front.
What do the sheep symbolize?
Well, sheepskin boots.
That's it. That's the whole thing. I did not focus my reading. I am less interested than you are in the lawsuits related to UGG. I get really interested in the running shoes, which we're going to talk about shortly.
Okay, yeah, we'll get there. We'll get there. But this is important because as you mentioned, we mentioned a couple times, there's just constant fights that are happening with Deckers, and this is another one that they're not only trying to figure out how do we get inventory out into the market, but they also sent letters to 20 different Australian footwear manufacturers so they can make sure to claim the use of the UGG name. They got to figure out how this can keep going. I loved this also, as there was a Connie Rishwain who had been there from the beginning running UGG. She put out this 7-point plan of success at this point in time for UGG. Number 1, position UGG as a luxury product. Number 2, expand market segments. Number 3, grow outside of California. Number 4, change perception of being a fourth quarter brand. Number 5, grow international business. Number 6, expand product categories. And the most important, number 7, send Oprah Winfrey a thank you note.
Connie, this is good. We talked about one of the ideas behind the acquisition was your biggest driver of sales before UGG is like a Q2 product. It's a sandal, right? And so the Q4 product is also hilarious because you bought UGG to counterbalance Teva, and then all of a sudden when UGG gets incredibly successful, you go, oh, we should sell UGG year round. It's the nature of business, but it's hard. I'm so happy that Connie and Angel Martinez and Doug Otto and all the other cast of characters were dealing with these stresses and not me, because it's what's great about being an investor. I like to just buy the thing, sit back, and go on easy street while they have to deal with the lawsuits.
You just get angry with them when they don't perform, but you don't have to do anything.
Yeah, exactly. It's just
which is fantastic.
Now, I mean, so walk me through it. I will tell you that from 2004, 2012, I mean, there's all the stuff happening. They're making some small acquisitions. They're working on this new whale that is UGG. They're still always trying to fix Teva. I don't know. This part of the company history to me is somewhat uninteresting. What do you find?
Well, there are a few things that happen, and if you just look at the stock, right, that's the basis for how we even started talking about Deckers. During that period of time you just mentioned, the stock is up like 1,300%. So something must have happened, right? So
it's UGG though. Like it's just UGG.
Okay, Kind of. I'm gonna hit on a few points, and you tell me what's interesting, what's not.
No, take it at your own pace. I love it.
Okay. All right. So the story at this point is UGG. UGG is growing quickly. Everything else is basically either slow growth or stagnant for the most part. This is when Doug Otto steps down. We talked about that in the last episode too. Doug Otto steps down. Angel Martinez joins in April 2005. And as we discussed around authenticity, Angel was a runner. He was an all-American cross-country runner. He was like the 4th employee at Reebok US back in 1980, grown up in the shoe business too. And as he says, I don't suffer fools well, to tell you the truth. I have no patience for that. So this is who's coming in to
All
run.
right, I'm interested. Go Angel.
And this is, a point, as you mentioned, they're trying to figure out, we've got UGG. We've already seen the movie before where you have a big brand, you build on that brand, it starts to stagnate, you have a second brand. Let's see if we can get ahead of this time. Can we figure out what that next brand is going to be? They purchased a few brands, as you mentioned there. This is also when they started trying retail, which lasts a long time, but they started opening up UGG stores, so brick and mortar UGG stores. By 2012, the end of your boring period, as you stated, there were 46 of these. And some of this could just be grandstanding as a CEO. You never really know, but I still thought it was interesting. In 2008, so this is when the great financial crisis is happening, recession is hitting in America. Angel Martinez is asked, are you worried about the U.S. consumer? And this is what he says. I never worry about the consumer. I worry about people's misinterpretation of what the consumer wants. If anything else, there's an over-proliferation of brands. There are a lot of people who claim to be brands who are not. There's a consolidation of retail that's overdue. We've been very careful about controlling our distribution, and a lot of folks have not. I think you're going to see the shakeout of that, and that might be painful. If you don't have a legitimate brand, then you don't have product that's a reasonable price-value relationship, and the consumer sees right through that. I think... Go ahead.
This is now I'm interested. Good work, Angel. This is what I see today, actually.
Yep.
I'm a sneakerhead, basically. I can't claim to be an expert in the space, but I've followed the space for 20 plus years and love every ounce of shoe retailing that there is to love. I'm just going to talk about today, even though Angel's quote is from 2008. I don't understand why every brand under the sun, every apparel brand, has decided to spin out their own shoes. In some cases, Deckers and Nike and Adidas and others are actually the experts in the space. Again, Nike spends so much money on R&D that it could step on any of these small independent apparel providers that decided to spin off shoes. The business economics of that in almost every case is horrible. I don't understand. Angel's completely right. And Angel was employee number 4 at Reebok, so you can trust him more than me. Yes. Also, so other things that I find interesting at this time, right? The CFOs, this is 2007. He's talking about, 2007, 2008. He's talking about how he still loves M&A, but the winning formula is organic growth with their brands, right? They want to build because it's just so much cheaper, right? And they are... The financial metrics, basically just revenue being the main driver, still continues to grow explosively throughout this whole period. Like, they're transitioning into a different corporation than they were in 2004.
Oh, massively. If you go back to the revenue they talked about in 2001, remember $90 million in revenue. 2005, that's $265 million in revenue. 2007, that's almost $450 million in revenue. It is a completely different company. If you think that this company almost sold for $100 million just a few years prior.
I have UGG's growth alone in 2007 at like 45%. I want you to remember that number because we're going to talk about other brands. Compound growth of 50% a year. It's insane. It doesn't happen at scale except for Deckers. It's insane.
So they're looking for the 4th brand at this point in time. The first 3 brands, Teva, UGG, Simple. They're looking for the 4th brand. We'll talk about what that is. It takes a few years for them to find the one that sticks. They start making small acquisitions, but to find the one that sticks takes them a few years. Also, as I talked about before, here's talking about the supply chain. The scarcity factor was not a glitch in the supply chain, but rather a carefully calibrated strategy. It's one of the big reasons behind the brand's success. Deckers tightly controls distribution to ensure that supply does not outstrip demand by operating just 3 freestanding UGG stores and selling to a limited number of department and specialty chains. Okay, keep that in mind. I think there's a lot of truth to that. And when we fast forward to the middle of 2010s, you're going to start to see a little bit of the opposite happening even with them. When that money starts coming in, it becomes easy for a company to lose a little bit of sight and control.
It's like an addiction. There's 2 other things that we may want to talk about in this period. One is I just want people to know that they've made a lot of other acquisitions where they took impairment losses. So in 2009, I don't know how to say this, Dougals, Tsubo, maybe it's TSUBO. They took $1 million impairment loss. Basically, the financials are stating that's a bad acquisition. That happens when you acquire as many companies as they acquire. And in a way, their acquisition strategy is a little venture capital-like. It's like they know that not all of them are going to have explosive growth, but you're trying to find the one that does. The other thing that I found interesting during this time period, specifically related to UGG, is UGG was 100% sheepskin boots, which meant that you were really dependent on the cost of sheepskin. And so I know they worked at diversifying away from that. Do you want to spend much time on that, or is it just worth mentioning?
We should touch on it one more time in not too long when we go to the troubles that Deckers hits in the mid 2000s. One other thing before we get there talking about sheepskin that I do think is important, this isn't just about sheepskin, but it hits on a common thread that we've talked about so far with Deckers, is that a lot of with the brands that have worked, it starts with utility, and then they add to that. If you think about with Teva, the utility, like they had a strong product market fit with a group of people, and the utility existed there with the sandal, with the sports sandal. With UGG, it's very similar. Like when people are just looking at Kate Hudson or Sarah Jessica Parker wearing her ruby red UGGs, you might just be like, oh, it's some fancy smancy just fad that's happening here, which sometimes these things can be. But the utility is important. Here's something I'm going to read. The sheepskin is twin-faced, meaning that the wool is still attached to the suede during the construction and dyeing process. That makes the fur very porous. So if you've always wanted to know why Angelenos wear sheepskin footwear with shorts in the summer, it's because the material is naturally thermostatic. The boots will keep feet cool in 80-degree weather and warm when it's 10 below. Breathability is key. I say that not necessarily because that's the entire reason why they're successful, but the reason I think that UGG has had staying power for as long as it even did, even with just the boots, I think was because they actually worked. Like they were super comfy. People talk about, I want to put my feet in them. Like I love putting my feet in the UGG.
You say were as if the brand is dead. Could we pause the show real quick? I've got to go buy some boots. That sounds amazing. I didn't know Uggs could keep my feet cool in the summer. This is amazing.
They can do anything you want them to do.
Yeah.
These shoes.
Wow. I sure hope so.
Put your foot in a sheep. It's fantastic. All right. There's a Teva turnaround starts to happen too. They try and put some innovation into that brand. Martinez, Angel Martinez, one of the big things that he talks about is making sure that people understand long-term vision, having a corporate structure that's around that, and they're seeing awesome success. One of the points that this brought up for me, I think I've said this quote a couple times on here, but I love this Robert Frost quote, and I'll tell you why it relates here. Robert Frost quote, "Most of the change we think we see in life is due to truths being in and out of favor." What that means in layman terms, the reason I like it, is because oftentimes humans end up going with the whim of whatever's happening at that given point in time, and usually things snap back to whatever the truth is. You talk about mean reversion all the time. Like things kind of snap back to like what is the truth of the situation. Here's how it relates to this. Martinez says, you have to focus on the fundamentals. Stay very clear on your customers' needs and make sure your products are great. And you must be very consistent because you then become a rock when everything else is changing. The reason I love that last piece, you become a rock when everything else is changing, because consumer sentiment goes up and down, left and right. They're always trying to figure that out. But if you can have a product, going back to utility, if you can have a product that works and works for a broad enough group of people, start with that niche for a broad enough group of people, he's saying, you're reliable. Like consumers know they can come to you because when they put the feet in the sheep, it feels good. Like they just know that.
This is where I continue to be impressed with Angel Martinez, like ability to run a company and to lead, right? I mentioned all these other apparel companies that have started shoewear brands. They're looking to companies like Decker to figure out what's in style or what the customer actually wants. But it's like a third or fourth priority for them. For Deckers, that's all they think about, right? And there's a visionary component of that, because there's one thing I want to mention. I can't find it in my notes exactly what it is, but during one of the tough times, there was a crossover collab between UGG and Teva, which I find to be the most
that comes later.
Like this tells you what people do when they get desperate. When times get tough, they're like, "Oh, this boot and this sandal, we're just gonna merge them." And
it was like an open-toed UGG. They just leaned into the ugly. They just they leaned into the ugly. All right. So now I'm going to fast forward a little bit. They're trying to find this fourth brand. It's been a few years. They have Subo, as you mentioned. They've got this brand Anu. They acquired Sanuk. UGG is 87% of sales in 2011.
And you go back to like the 90s when Teva was 87%.
Exactly.
You know, they all of a sudden they thought Teva was the whale, and now Teva's this tiny minnow in the UGG whale.
Yes. Now let's go back to thinking about utility, function, craftsmanship. In 2006, a couple French people that are good at creating stuff for people's feet. I say that because they last created parabolic skis, so it's not just shoes. But they're just good at understanding how the foot moves, what to do with the feet. From scratch, they decide we're going to rebuild a running shoe. They're not going to take what exists out there and incrementally build it. So we're going to rebuild a running shoe. Over 3 years, they developed the shoe and they launched it in 2009. It becomes a real brand in 2010. Now we go back to Decker's timeline. 2012, Deckers buys a minority stake in this company called Hoka. And in 2013, they fully acquire Hoka. So unlike what they did with Teva, this is not a long, drawn-out process before acquisition. They just buy this thing. It's unbelievable the amount they spend here. I don't even know where they got this money from. How much did they spend on Hoka?
1.1 million.
1.1 million.
Laughable. It's laughable. It's okay. And Hoka's sales at the time were, all I have is less than 3 million. Let's call it 3 million, right? Hoka is a tiny little brand. I don't know if you remember Hoka advertising from that time frame.
I don't.
But like, I live in a running community that's on the forefront of this stuff. It was bad. It was... It looked like two guys that had worked at Solomon and didn't know how to run a clothing or a running shoe company. It was rough. Do we want to jump straight in? Because I find this to be the most fascinating part of the entire story. Sometimes I fall asleep at night and dream of buying a shoe manufacturing company for $1 million. Like
as we all do. I'm gonna say one more thing that just supports what you just stated, and then I want you to jump in. You want to jump in after that? Okay.
Yeah.
So this just supports exactly what you stated. At the time we made the purchase, this is, I think, Jim Van Dyne, who ran Hoka after they purchased it. I think this is him saying this. At the time we made the purchase, the U.S. business was being run by a distributor based in Canada that had no real experience in running a footwear brand whatsoever. And it certainly didn't have the capital resources that needed to be invested. You need to find that company. The company where you've got this awesome product, no one really knows what they're doing, and you're like, $1 million? Oh yeah, sign me up. Like, I've been doing this for a few years, I'll take $1 million. That is a gold mine if you have all the backing they had in order to push it forward.
And listen, just 3 months ago, I tried to buy a minority stake in a Canadian shoewear brand, but they shot me down. Anyway, let me give you some numbers. Okay, acquisition price $1.1 million. We got to call the acquisition 2012. Okay, fiscal year 2025 revenue estimate for Hoka brand alone, $2.2 billion. Okay? From 3 million to 2.2 billion. Compound annual growth rate from 2012 to 2024 is approximately 51%. They grew sales 50% a year. It's not doubling. It's pretty dang impressive. For 12 years, okay, the most recent quarter is $650 million in sales, still growing 19% year over year. I mean, on a huge base now. No, now we're talking billions, not a measly millionaire now. The standalone brand valuation estimate. Remember, they paid $1.1 million for it. at a conservative 4 times sales multiple is about $11 billion. This brand is worth $11 billion today. And 12 years ago, they paid $1 million for it.
That's good return on investment.
It's crazy. Now, this is, again, I'm a shoe nerd and I want to talk about this. Do you remember the first time you put on Hokas and sprinted down a mountain? Have you done this?
First of all, I don't remember the last time I sprinted down a mountain. Like, was a bear chasing you? Or mountains? Or bears and mountains?
Okay. So the founders, when they designed the shoe for 3 years and then ultimately released the product in 2009, they were inspired by the feeling of flying down mountains. Okay?
Oh, okay.
This is probably niche. I'm probably the only one listening that actually does this. But if you run up a mountain, it's not so much fun because you're running up a mountain. When you run down a mountain, it's a lot of fun, unless it hurts your feet because you're dodging rocks, you're landing on huge things. The very first time you put on Hokas and decided to sprint down a mountain and they were like these little trampolines on your feet, it's an amazing feeling. It's a feeling that they carved and built for a very specific purpose, and now 99% of people wearing their shoes wear it simply because they like that trampoline when they walk to their office, right?
Yeah. Here's the technology. The foam used in the midsoles is 30% softer than the material used in traditional running shoes, and there's 2.5 times more midsole volume. This extra cushioning dissipates up to 80% of the shock associated with heel striking when running. This is a quote from that period of time. So the technology has shifted. Sure, at this point, it's not exactly that. But back then, that's how special those little trampolines were.
So special.
Okay, so you're telling me now that this is when happily ever after happens. Okay, now you figured it out. You had those issues back in the early 2000s. You had those issues. You learned from them. Now you got UGG going. You bought this brand that's going to have 50% CAGR over the next decade plus. We're good.
I tell you, happily ever after happens in business, right? You buy Hoka praying that they'll sell $100 million, and all of a sudden when they're selling billions of dollars, you have supply chain issues and 1,000 other problems.
Well, if you believe that, people, incorrect. Oh, not what you just said. If you believe the happily ever after, incorrect, because exactly what you just said. So remember that dollar we talked about investing at the IPO? That dollar went down to 9 cents, then it came back up to $1 in the early 2000s. That dollar is now almost $15 at this point in time. You go to late 2011 or 2012. Whew. Unbeknownst to the folks at the organization, they would not see that value again for another 6 years. A lot then shifted inside the company. I'm going to run through a few things. You cool if I do that?
Please.
Okay. So during this next few year period, UGG remained 70-ish% of sales and heavily dependent on the classic women's boot. Yes. Then although it's so breathable, there were a couple really warm winters in fiscal year 16, fiscal year 17, and there's some fashion cycles. What you mentioned before around the sheepskin prices, the 2011 to 2014 period, sheepskin costs spiked. So then there was a lot of volatility that was happening in the gross margins for the organization. Deckers, they had that experiment with retail, the retail brick and mortar stores that I mentioned a few years back. They kept investing in that retail expansion that hit on SG&A. In summary, during this period of time, UGG, much slower growth than they had seen previously. Hoka, growing really quickly, but very small. So when you have a business this large, those numbers are not going to be very impactful.
And no one in their right mind would have said that that growth would be promising for the investor, but no one would have believed it's like a multi-billion-dollar brand shortly. Yeah. And so it's hard to make your investment thesis off that. If you're on the ground reading the 10K at this point, you're more concerned about the operational challenges and the sheepskin costs than you are about what's happening with Hoka.
Precisely. And so if you take that price in like the 14 to 15, that $1 that you invested, now $14, $15, your price ends up dropping by about 50% over the next couple of years. So mid-2016, the price is about half. The stock price is about half of what it was before. You get Connie, our girl Connie, who at this point had been with UGG for about 20 years. She was running president of UGG. She steps down as president in 2015. She'd taken that brand from about $10 million to over $1.5 billion. Awesome run, Connie. Good to have you. Jim Van Dyne steps down as president of Hoka. Jim, a little brief history for Jim. So he came over, I think, by an acquisition. I didn't see that specifically somewhere, but I think he came over by acquisition. But he has known Angel Martinez for a long period of time. They were at Reebok together. Angel hired him to be GM of a retail store yet at some point. They've been together for a long period of time. Jim Van Dyne steps down. Angel Martinez steps down in 2016. Huge leadership shakeups. So stock gets hit. The leaders of their big brands step down. The CEO also steps down. Big shakeup. Dave Powers, who became the president of the company of Deckers around this time, gets named the new CEO after Angel Martinez steps down. And he comes in and goes, nah, people, it's on like popcorn. Here are the problems that he names, and then the stuff he starts to put into action. And as we've said many times in Deckers, they hit these troublesome moments. And what I have not seen them do to date so far is huge panic. They seem to, I'm going to say this a little bit loosely, but it seems like more in their success times is when they get a little loosey-goosey. But during the periods of distress, they actually get much more disciplined. They take bets and they get risky. So I'm not saying discipline isn't conservative, but they just get much more disciplined.
Well, just let me hop in. So Jim Van Dyne, early career at Reebok, that's where he met Angel Martinez. And then he led explosive growth at Keen Footwear. And then Angel tapped him with the Hoka acquisition. And early in Hoka's tenure, Jim is quoted as saying he thinks there's a 95% that this brand is going to $100 million in 5 years. That confidence built on the expertise is accreditable. But to your point about distress and riding through distress, what I want to give props to, I think this is where you're going, with the board in 2015, they authorized a $200 million buyback. And I'm going to hammer on this period how important the buybacks were. But the stock pulled back, right? The stock went from roughly $15 a share to $7 a share, and they acted on it. They bought back shares, which amplified all the future stock performance because there's less shares outstanding. Brilliant.
That's right. Yeah. And that continues. I know you're going to hit on that over and over again. That continues. So a whole bunch of turmoil. They'd overexpanded on the UGG concept. Too much, too many retail stores. Oh my goodness. Does history always have to repeat itself? Deckers up for sale again.
The UGG sold so many products that there were 3.7 items for every woman in America. That's that, right? Seems crazy to me.
It is what it is. So even to give credit where credit's due, even during all this turmoil, the stock is still over Angel Martinez. His tenure, it's up about 600%. Was up about 1,300% till you had that 50% pullback, but more power to him, right? That's a powerful time. Through the great financial crisis, it's awesome for leadership, not just Angel Martinez, but leadership in the company as a whole.
I'm questioning my notes here because of the way they're compiled. I have on October 26th, we'll call it October of 2017, that at the same time, basically, they are contacting 90 potential buyers.
Yep.
They are also authorizing a $400 million stock repurchase program.
That's right. Yeah. This is what
How
happens.
often does that happen?
Nearly always. So this is...
Nearly never.
So what happens, again, we said this is up for sale again. If you go back to the early 2000s when the company is up for sale, it wasn't so much that Decker said, okay, I think we want to sell the company. It was something happening from the outside. Similar this time. Mercado Capital, they ended up owning almost 10%, 8.4% is the number I have here, of Deckers. So started buying up Deckers. Then they go for a change in control, proxy battle. And they start saying, your stock's down, mismanagement, you guys are terrible, you're awful human beings, you can't even put your shoes on right, just whatever. He's saying whatever it took to make them sound bad. So Deckers, they authorize additional stock buybacks. They go to put a little poison pill. A poison pill, for those that are not familiar, is when someone's trying to aggressively take over the company, you say, okay, if that happens, then something else bad is going to happen. In this case, what they said they're going to put into place was over $100 million in liabilities would come due immediately, and the executives would get paid millions of dollars. Is what they said. You can do this. What Mercado wanted to do was change the entire board, 100% shift in the board of directors. What the board wanted to do was make more money for the company.
And to our friends at Mercado, I don't know what you guys are doing. These proxy battles are cute, but just go buy Hoka in 2012 at $1 million. Come on, guys.
Yeah, just do the thing that runs the business.
What are you even doing now? They're also 2007. They're doing more impairments for bad acquisitions. This just happens. It's fascinating that truly, I think there's an incredible. Well, I would call this a proven fact at this point, based on stock performance. There was an incredible leadership team at Deckers in 2015, 2016, 2017, 2004, etc. Right? Incredible leadership team, and you still have random investors coming in and picking fights, trying to get all those people that have been in the industry for 40 years to move on.
Yeah. And in addition to that, or maybe not in addition, I'd even say as a testament to that, one of the things I enjoyed most about the story was they were just always fighting. It would be easy for, let's say, the average person during many of these time periods to be like, "Woo, we just crushed that. Yeah, we can sell out," or whatever the case might be. I mean, you can go back to 1990s, the early 2000s. They have these big successful moments and trouble hits. What do? And they just keep fighting constantly. There's no resting on laurels. And they keep the business hungry, I think, in a way, with aggression. Meaning you can have a business become complacent if you don't need to fight. You know, sometimes you can sit back and success. They have high margins. Their margins in this business generally were about twice the average in the industry. They have these really high margins. They could sit back and just be like, we got cash cows. We could be the best bond of all time. They don't do it.
Yeah. Well, I mean, the margins are all related to the premium brand.
And keeping some of that scarcity, which has shifted a bit with Hoka. I mean, I buy my Hokas at Dardano's. You know what I mean? It's not. I get my peaches out in Georgia. Okay. So they had, as I already said, they were like, we've opened too many stores. We've acquired too many brands. We've misallocated our inventory. We can't find new customers. All these issues. Dave Powers takes over as CEO, and he says, all right, so here are some of the things we're going to do. We're going to reset UGG. So UGG, huge part of the business, and was largely the women's boot, the classic women's boot at this time. We're going to expand into men's, into lifestyle, into slippers, other apparel. We're going to push the counter-seasonal product so that we can smooth some of that seasonality, so sandals, sneakers, etc. We're going to focus on our international expansion a bit more. And so then if you fast forward a few years, by fiscal year 2022, a little over 65% of UGG sales came from non-classics. So they successfully diversified within UGG. Then with Hoka, we're going to invest in more innovation. With Hoka, the soles I talked about before, how can we make that even more innovative without necessarily just merging it with the UGG shoe? Not that kind of innovation, but other innovation. And Hoka growth is going to be critical. So if you go from the beginning, that $3 million in sales when they purchased it, to give you a few numbers here, by fiscal year 18, we're talking about $150 million. By FY 20, $350 million. 2021, $571 million. 2024, $1.8 billion. And at this point, basically, Hoka grew out to be even or sometimes a bit above UGG. So they have successfully done that. Biggest shift, I think, from a profitability perspective, and then we can go back, that I think that Dave Powers pushed was direct-to-consumer. They had direct-to-consumer in their own retail shops, but they started closing those retail shops and investing more into e-commerce. And this changed the entire margin landscape of what they were doing when it came to direct-to-consumer. In fiscal year 2013, about 29% of their business was direct-to-consumer. That grew to over 40% a bit later, and it was more profitable dollars. The other nuanced thing that happened in the direct-to-consumer that I thought was interesting was the strategy they took. Was they said, we're going to close the stores because structurally they're unprofitable. But the stores are important to get the tactile feel. And so we'll have the stores that we do have are going to be more of, they're showpieces, kind of like what Apple does with its retail stores, right? We don't necessarily need more and more of them, but we want those to be places where people can come and feel good in our wares. So I thought that was an interesting shift from a profitability standpoint.
First, just on the net sales, you mentioned, and I've mentioned as well, Hoka revenue for fiscal year 2024 is $1.8 billion. So just round to $2 billion on that.
Yep.
Total company sales in 2018 were about $2 billion, right? So one brand is now the size of the whole company. That's fascinating. The direct-to-consumer piece is a very slippery slope. Any consultant that walks into any shoe brand that does a lot of retail footwear immediately says, well, here's how the numbers work. You sell the shoes for $160.
Yep.
If you sell it to the retailer, you have to sell it to them for $80. You probably make it for $40.
Yep.
So the direct consumer space, you make it for $40. You turn around and sell it for $160. Obviously, the profit margins are explosive. Nike struggled with this and has struggled with this recently. That is great until it's not. It's great when your profit margins are significantly inflated and you have success there. It's bad when 5 years later, those consumers don't see your shoes on the shelf and forget they exist. Yeah. And then they buy what's in front of their face.
There's a reason that retailers take a piece of it.
There is. And so that balance is like very careful. It's so much easier for someone to walk into a store to do something else or to look for something else and see your shoes and they like the colors and they catch their eye and they forgot that the shoes they're wearing were worn out. Pick that thing up. It's mind share, right?
Yep.
So I just have to.
Yep. Yeah.
I've been bitten by the direct consumer piece in investing, and of course the margins make sense, but it's not always that simple.
Yeah, and as a company, I don't mean this in a short-sighted perspective, but let's say 5-7 years at a time, you have to look at what are the facts sitting in front of you, and therefore what's the strategy for the next period of time. And at some point, that strategy just doesn't work forever, no matter what it is, direct-to-consumer being a core piece of it.
It's also cyclical, yes.
Right? And so if you go back to the mid-2010s, when they're like, we have expanded to, I can't remember the number, but I think it was over 200 UGG stores, like something like that. They'd expanded from like the one that they tried in the late 2000s to at this point. They go, okay, that's not working. But people do enjoy coming in and feeling the sheep. Like they love coming in and looking at it. And we're a premium brand. We want to have some control over the experience that folks have. So how do we balance that? At that time, you'd be like, okay, well, direct-to-consumer does work for us, but e-commerce is going to be more profitable. Let's cut that 200 down to 120. Boom. And then you have to know, when doesn't that work?
They clearly didn't have enough stores because I didn't even know I could stick my feet in a sheep and have comfortable feet in the winter. Like I learned this today, Douglas. So
you were today years old.
Let me continue to talk the financials. Deckers does not pay a dividend. To my knowledge, has never paid a dividend, but I'm only looking at the last 20 years here. Okay? Everyone knows what a dividend yield is, right? If the stock trades for $100 and they give you a dividend of $4 at the end of the year, that's a 4% dividend yield. Less people know what a buyback yield is, and it's allocating the same amount of money to buy back shares of their stock. Okay? So from 2015 on, they have bought back shares every year. In 2015, they bought back almost 12% of the shares. Yep. In 2018, they bought back 8% of the shares. 2019, 5% of the shares. And in recent times, it's hovered between 2 and 3%. They've reduced share count by like a third.
It's huge.
Since 2009. It inflates the results of their site. The revenue per share is then leveraged in a positive way as you have. So you have Hoka growing at 50% a year. You have UGG continuing to be a powerhouse, and you're reducing the total number of ownership shares that are out there. It's a huge catalyst for growth. I know I'm probably a broken record here. There's 1,000 things that have to come together for this to be one of the best performing stocks in recent history. Yep. That is a key component. That the chart does not look like that if they chose to allocate that money differently. Even if they just would have returned that money to shareholders via dividends, the money moves off their balance sheet, moves to my brokerage account, and they never see it again. They made really wise investments here. Can you make a wiser investment than to buy back stock in 2015 for a stock that's going to perform this well? You probably can't. Like, that might be the best investment that has happened in... I'm struggling for adjectives. It's probably not the best investment in the world that happened in 2015. It's one of them.
Yeah, and when you have a new product that's growing 50% a year, you think about the difference between paying a dividend and investing back in that thing. I mean, having these CAGRs is out of control. One of the things, this is entire speculation here, but as we think about the future of Deckers and the stock, you have the Tiva ride. I just said it. Oh my gosh, you done...
Look at you.
You done ruined
We won.
Me.
Good job, team.
So you have that ride where you get up to that 70-ish, 80-ish% of the company is made up of that. Then you buy UGG. UGG starts at nothing, builds up to the 2013-ish time period where UGG is now 80, 90% of the company. You buy Hoka. Now UGG and Hoka are about neck and neck. If you take history as the future, which it never turns out exactly that way, but for the funsies, let's just say you take history as the future. Sometime in the next 5 years or so, UGG is probably going to be 15, 20% of the company. Hoka is going to be 60, 70% of the company. And you got to figure out what's next. If you look at history, who knows the way the future is going to be. Let's keep watching this company and see what they do. It's utterly fascinating, I think, this story.
I mean, and I know the management team is listening at this point. Guys, could you make some better color combinations for Hokas? They're just so ugly.
No, it's wonderful.
The blues and the whites. Come on, guys.
I got so many. I told you I buy Hokas. So I get a new pair of Hokas like every 4 to 5 months-ish, something like that. So it ends up being 2 to 3 pair a year. And every time I want a new color. I'm now onto the colors that I've tried to avoid historically.
Yeah.
And so it's like, and I don't know where they come up with these names, but it's like eggshell, whale oil white or something I'm on with like, then they have like a splash of brown. I don't even know but this is what I'm into. So I actually don't need better colors. I just need more. Like, give me more.
Well, let the listeners in behind the scenes. This is why Dougal's friends call him clown shoes. I mean, that's... I'm with you, and I didn't mean to end so abruptly. Let's continue with maybe... We're roughly in 2024 timeframe now with the history we walked through.
Yep.
And if you look 5-10 years into the future, and history repeats itself, and anyone that's listened to this 2-part episode knows how many challenges will happen in the next decade for this company. And what will happen to the stock price? It will probably go down at least 50% and up at least 50%. And who knows what else. But we're at the point where, yes, maybe Hoka becomes a dominant brand, like the unquestioned dominant brand. But they're probably out there hoping to buy some other brand for $10 million, and they'll buy 10 of them. And they hope that one actually turns into the next dominant brand. But the amazing part about that is they now have, we talked about the foundation they built for the first 30 years of the company. Now talk about the foundation they built for the first 50 years of the company. They still have these great relationships, this great history of taking small brands and getting them noticed, continuing to demand premium prices at high margins. There's no one better equipped, right? If I had a shoe-wear manufacturer today, there's no one better equipped to take that from $3 million in sales to billions in sales than Deckers Outdoor.
Yeah, that's true. Very true. And what that gets you, we're just talking end of 2024 here. So ignore anything that's happened in calendar year 2025. What that gets you is the difference between what we discussed back in 2001, where you had a $90 million revenue company trading at $40 million market cap, to a $4 billion revenue company trading at a $30 billion market cap. That's what that gets you from a valuation perspective. And the market is betting on what you do with that next. One material difference, and correct me if you saw something that disagrees with what I'm about to say. One material difference that I see with the company now versus where the company has been historically during all these periods of time, something we brought up over and over again, is historically, I'll start there and end with where we are. You had the surf bum in Doug Otto, who creates the flip-flop for the people that his people he knows well. You have Mark Thatcher, who took that, made it into a sports sandal. He was the river guide. Then you go into the Australians, and then Brian Smith, the Australian in California, surfer, who makes the UGG boot for keeping the feet warm. Right? Yep. You have all that. You have the runners, Angel Martinez, all-American cross-country runner, Jim Van Dyne, runner, Hoka. The people that I see that are in leadership now are apparel and shoe people. They know this industry in and out. What I don't see, that doesn't mean it doesn't exist, but what isn't pushed as hard, even if it exists, it's like, doesn't seem to be pushed as hard in what they talk about, what they write about, is that like, I am the person that I'm developing for. So if history is going to repeat itself, whatever next brand they buy probably need that human or some group of humans with that brand that can authentically develop it.
There's a lot there, Dougals. I have thoughts, unsurprisingly.
Yeah.
So what's fascinating is You talked about the history of these people that were deeply invested in their endeavor, whether that's running or surfing, basically, or river rafting. But then the only way that becomes a billion-dollar business is if you sell to non-river rafters, non-surfers, non-runners. The reason Hoka does $2 billion in sales, it's not because they sell to people that run down mountains, because very few people run down mountains. So we talked a lot in episode 1 about authenticity and how when they lost their authenticity, their sales sputtered. Mm-hmm. I think what everyone struggles with, I'm very familiar with Nike, or much more familiar because I own stock there and follow the company. They've had this crisis in the past 3 years of it seeming like they weren't hardcore runners, and that was the core of the company when it was founded. That's the core of the company when it's successful.
Yep.
What I don't know is how you continue to have that success. You have to find this next authentic brand, but then you have to sell it to people that like the idea of doing that authentic thing, but don't actually do that authentic thing. In sports franchises, there's a term called Walmart fans. Have you ever heard about this?
No.
So this particularly happens in college sports, but you have a brand, and we envision the University of Alabama, but it's not about anyone specifically. You have a stadium with 90 to 100,000 people, and you have an enrollment that does not fill that stadium. And a lot of people that graduate from your university move elsewhere. The only way you sell 100,000 tickets is if you have a lot of people that cruise to the store, see that college brand, think that's cool, put it on, and aren't necessarily alums. It's great. That's how you build the business. I see that as similar here. You need the people that want to be surfers, that want to buy the surf brand, that aren't ever going surfer. You need the people that love the college football team that never went to the college, right?
Mm-hmm. That's right.
I think that's tough to pull off. They need the fourth miracle now. If the next 10 years of this company is going to be incredible, you can believe a couple things. You can believe that Hoka will continue to grow at 50% a year, but at this scale, I think that starts to get tough. I don't know. Mm-hmm. Tell me your opinion on that. Or you can believe they find lightning in a bottle for a fourth time, and that also seems pretty challenging.
What this reminds me of, and I'll bring it back to try and hit on your point directly, it makes me think of Apple. If you look at the Steve Jobs to Tim Cook transition, you could say something similar. And that, when it comes from innovation, because the authenticity led to the innovation and part of the marketing before. The loss of Steve Jobs back in, was that 2011, 2012, one of those years, for Apple was also that's the core innovation, the design, who he talked to was gone with him. Tim Cook is an operator. Tim has then been able to take the company, its brand, its innovations, et cetera, before, and figure out how do you multiply that from a business and ops perspective, not as much from an innovation perspective by any means. And so I bring that to Deckers. They should obviously try and find the fourth lightning in the bottle. You have to try and find that. Maybe these people also can go, okay, so what we have is a $30 billion. I'm just taking the end of 2024 prices. I know it's been cut since then. We have a $30 billion company. Through our know-how of the industry, logistics, operations, relationships, marketing prowess, can we turn $30 billion into $300 billion? And you may not need the next brand. And you just go how do we get Dougals to buy 6 pair a year? Whatever the thing is. Mm-hmm. How do we make sure that if your granny is going to get up and strain her feet to go get that soda pop from the fridge, she does it in Hokas or in UGG slippers? How do we figure that out?
Maybe. I mean, that's where I don't know if that strategy is public, but I'd love a look behind the scenes at how they're getting the $300 billion. I'm going to be factually correct here. The stock almost got cut in half since the end of 2024. Its current market cap is $17.5 billion. Now, it's not crazy expensive. When I look at it from an analyst perspective, I go,
it's not cheap.
I could see some potential value here if you believe it and the growth story is continuing. It's a fascinating watch right now. It's not a screaming buy, it's not a screaming sell, probably. Maybe it's in the range of fair value. But just a fascinating company. I'm truly love talking about it. I'm glad you brought it up.
It's a fun story and there are many sub stories within it, which makes it ever more fun. over 50 years to create this business. They had to go through so many periods of innovation, iteration, stock cut in half, stock cut by 90%. You've brought that up many other times around how these stocks that compound over long periods of time, you have periods where they go to almost nothing from a relative perspective. Like, this is just what happens. And so I'm glad that we were able to go like year by year, period by period, and say what was going on at that point in time. What must have they been thinking about? How did they then get through it, get around it, etc.? It's been a ton of fun. And I also, as someone that has bought this many pairs of Hoka, up until 7 months ago, I'd never heard of Deckers.
Most people have not. I think it's fun that next time you go to your premium local shoewear brand store to realize that 7 of the 20 brands they offer are probably all owned by Deckers. Like, Deckers runs that place. It's the illusion of choice. Now, I have 2 favors to wrap up. First is, if you like episodes like this, let us know. A lot of people did that last week, and we appreciate that feedback. These are pretty research intensive, and so if you want more of these, we'd love for you to become a premium subscriber. You can do that at skippydougals.supercast.com. Support the show. Get your typical show a day early on Sunday instead of Monday, and other perks when we talk about potential investments we're looking into. I would personally love, this is just me and no one else. I'd love it if you'd make fun of Dougals for wearing clown shoes, and I'd also love it if you're going to buy Uggs like I am later this afternoon, or sporting some Hokas right now, if you'd take a picture of those things and send it to skippydougals@gmail.com. I want to see some of these around town. I want to see our listeners sporting these shoes. This great brand. Truly, truly a great brand. Love it.
Do it.
I did not buy the stock. I almost bought the stock last week just to have like a keepsake, some commemorative shares of the remember when we talked about it. But I may at some point. Just, kind of that.
I like it. I love
Frame the virtual stock certificate on my wall and say, I remember when I wasted hours of my life researching.
I just have on my wall, I have a framed picture of a dude outside the headquarters with a flock of sheep. So we all choose what we put on our wall.
Other than that, thank you for hanging out with us.
Yeah.
We'll see you next week.
Bye, everybody.